It's time for Ask Annex. Got a question? You head to our website, annexwealth.com. In the studio, Fred Coleman, Wealth Manager at Annex Wealth Management. Welcome to the show. Thanks, Danny. And we got Matt Morzy, Investment Team Manager and a CFP. Welcome to you.
Hey, Danny.
First question is, my buddies say I should look into Quant Funds. New to me. What do I need to know? This must have been another backyard discussion, right?
Yeah, for sure. I love those. Quant Funds really is a general term and it's short for quantitative. And essentially what it is using math in order to find a way to improve your investment outcomes. So a lot of times it's going back into history to find different correlations between asset classes or trends within asset classes and trying to use what's happened in the past to predict the future. The end goal is that instead of having a stock picker or a bond picker that's actively manage your portfolio, is that you're trying to take that emotion out of it and saying, I just want certain things to happen at certain times because it's happened in the past. Now, the risk with that is that the future is not always like the past. Just because in a high inflationary environment in the past, certain stocks might have done better than others, doesn't mean that's going to repeat itself going forward. So you're kind of relying on that happening. The other thing that they might be trying to do, because again, this is a pretty broad topic, is that maybe they're trying to find different trends that are happening in the market. If certain stocks are above a certain moving average, to them, that's a buy signal. If they fall below that moving average, it's a sell signal. Now, there's legs on a lot of these things. And again, you're hoping that what's happened in the past will continue to happen in the future. So the range of outcomes could be very, very different. This year, as an example, stocks are up quite a bit this year, but a lot of the quant funds have underperformed this year because it took them a little while to get into that game, and they're lagging performance so far this year. But again, that's not all of them. Again, it's a broad topic. So you really got to know what you're getting yourself into, know what the range of outcomes are, and understand that they're probably designed to do something different than what the general market's doing. So you might have a very different result.
You said that it's a lot of math.
Yeah.
And there's a human factor. Is this something that AI will pick up down the road?
I would assume so. And really what they would replace in that is all the work that goes in ahead of time to try to figure out what you're trying to figure out. A lot of this, again, is based off of what's happened in the past. And so AI would be able to do that really, really quickly versus somebody on Excel or trying to use, Python or these different programming programs in order to figure that stuff out. But at the end of the day, what you're really trying to get out is that human element of deciding, I want to buy Apple today or sell Apple today, because the math is going to tell you what you should do.
Next up on Ask Annex, and it's a big one. So, Fred, here it comes. I'm a 39-year-old male, have just over $200,000 in retirement accounts. This is between $150K in my 401K and $54K in my Roth IRA. That doesn't include my HSA and brokerage accounts. I make $100,000 a year as my base salary before bonuses, which can vary. I thought I was doing okay, but I guess I need to save more since I read I should have 3 times my salary by 40. Is that a realistic expectation? I save 15% of my salary into my 401K and get a 6% match. I also max out my Roth IRA and HSA every year. First off, good effort, right?
Yeah, absolutely. You're doing a great job saving. You're doing all the right activities, and that's the thing that you can control. I wouldn't look at any of those numbers that you see online as hard rules because they don't know your specific situation. Many other things come into play when determining how much you should have. Are you retiring early, or do you want to work for a long time? Do you have debt? If you have less debt, that $200,000 is going to go longer way than if you have a lot more debt. What will your lifestyle be? All those things come into play. Taxes, Social Security, family. You have to take all those things in consideration, and that's where the planning aspect comes in at. So I would say continue focusing on those good habits that you're exhibiting. Put a plan together. Continue maxing out that HSA, Roth. And if you can, put some more in that 401k and you'll be in a good spot.
Next up on Ask Annex, high net worth individuals defined by Capgemini as those with $1 million or more in investable assets held over 34% of their portfolios in cash as of January 2023. Should I try to mirror that?
I think a good way to sum up this question, actually even the one before, is don't compare yourself to others because your situation is going to be really unique to yourself. Just as Fred was going through, your situation is going to be different than somebody else. So how much you have saved and what types of vehicles is going to be really important to you specifically, but not others. Same thing with cash in a portfolio. When they're looking at people with $1 million or more in investable assets, that's $1 million or more, and that number could get pretty big over that. So that's going to get skewed by people who have hundreds of millions of dollars who might have cash for specific reasons. Maybe they just sold a company or they're going to be looking to buy another company. For you, you want to look at, okay, what's the purpose of the cash in my portfolio? Generally here, we like to have lower levels of cash, but if we are going to be a little bit elevated, things like money market markets, treasuries are going to be a way to get a yield on that while you're waiting to be able to use that cash for something else. But again, we're looking at it from a portfolio concept, and we'd rather have you invested and making more money off of that as possible from a risk-adjusted standpoint. So I wouldn't compare yourself to others, but I would look at what is your goals, what's your goal for that cash portion of your portfolio, and what are you trying to achieve.
Matt Morzy, Investment Team Manager, thank you.
Thank you.
Fred Coleman, a Wealth Manager at Annex Wealth Management, thank you.
Thanks, Danny.